pleased to see that your flagship, the Global Fund, the Magellan Global Fund, weathered the market storm really well to date. In fact, I think it's still positive of 3%, depending on the day you look at it, versus a negative of about 5% in the market itself, or the index. I guess the question is, what's your strongest risk management tool that you've had in your toolkit to achieve this extraordinary result?
Well, Rod, the most important thing we have from risk management is our portfolio construction. I often have said to people that we design portfolios to deal with a black swan event. And this is a black swan event. I often have given an illustration of a black swan, and a global pandemic is something I often cite. I also cite a sort of global bioterrorism event as being a black swan. Both these things are likely in our lifetimes, but you could never predict when they're going to strike. And we haven't been able to predict when this one was going to strike. Neither could we predict exactly how the economies would play out. And we went into this crisis with 5 or 6% cash. And the portfolio, because we run something called a combined risk ratio, and we run that risk ratio, which is a combination between the drawdown risk and the volatility risk in the strategy, at 0.8, we're always running materially less downside risk than the markets run. So when this struck, and before we did anything further to take any further action in our portfolio, the portfolios held up very well. So we deliberately designed, we're not guaranteeing, but we're deliberately designing our portfolios to deal with a train wreck that we don't see coming. Of course, as this started to play out, we then took some action to get more defensive in the portfolios. We have moved from sort of 5 or 6% cash to over 15% cash in the portfolio. We have sold down materially our emerging market risk. We've sold down our sort of luxury exposures that are put at the pointy end of discretionary expenditure, things that may be more sensitive to spending levels in the economy, like a Visa or MasterCard. We've sold down some of those exposures. Still great long-term businesses, but we want to have less risk. So now we held up well when we didn't do anything. We've now made the portfolios even more defensive. So if things turn down again during this crisis, we feel that we're well positioned. And if they don't turn down, and we've got 17% cash or 16% cash or whatever the number is, we're still 83 or 84% invested. So we're feeling pretty comfortable, and we're probably even more defensive at this point than we were heading into this crisis. But it's portfolio construction that is really, really important here. And, touch wood that we had talked for people for many years about our downside protection, and an event like this happens, a black swan event. And at the beginning of this, Rod, we thought this was a localized epidemic in China. I was in the newspaper saying this doesn't look like a global pandemic, and we're fairly fully invested. And, I quickly changed my view within a week or so around that as it started to spread into Italy and other places. And it looked like it was a lot more serious than at first appeared. But it just shows how quickly these things can move. And you really have to have the right portfolio to deal with events like this.